I get a lot of questions from Options Geek members about the wheel strategy. Even worse, they come to me after they've lost money or they've blown up their account. Let me be clear, the wheel is an extremely risky strategy for most investors. It entails a lot more risk than you might think, and surely more than anyone is talking about. In this video, I recorded a one-on-one coaching session with an Options Geek member to give you an inside look to basic concepts you need to understand, the real hidden risks that no one talks about, and the most important part of the wheel that investors ignore. I hope you enjoy it.
What I've read is you pick a stock you like. Stocks
Okay.
generally go up, right? So,
Which stock are you looking at?
I like AMD, so it might be a little expensive.
Okay. So you like AMD, you're thinking about the wheel. We should take it back a little bit because the wheel is something that has gained a lot of followers over the last few years. I have a couple of issues with it. I think the risks are not explained correctly. So before you even get into, I want to do the wheel and what the wheel is and all the nuances, we really need to understand the concepts behind the wheel and then understand the risks. Only then we can make a decision on whether or not this is the right thing for you on AMD, on the SPY, on whatever it is. So let's talk about the wheel just in general. And let's talk about strategies in general. So the first thing I would say is the wheel is a strategy. Fair. I guess the question would be, is it a valid strategy? Right? Strategies are either long-term in nature or short-term, long-term or short-term. And you have to know who you are as an investor or what you want to be. Now, some of your portfolio could be long-term, some could be short-term, but you have to understand the differences between the two, the psychology and the methodology that's happening within your strategy. So long-term versus short-term. And in long-term strategies, buy and hold, buy the dip. You want to hold it for years. You're thinking, I want to be Warren Buffett. I want to own Coca-Cola for the next 50 years. I want to own Lucid or AMD for the next 5 years, 10 years, whatever it might be. That's different than short-term trader, short-term active investor, hedge funds who are long a stock for the quarter or for half a year. That's fairly short-term. Okay. So you have to first understand, I'm going to be this person or I'm going to be that person. Okay. If you're going to be a long-term investor, then, on the scale of analysis, right, there is different things you can do to come up with an idea. You can do fundamental analysis, technical analysis, options analysis, data analysis. These are types of things that you would do to actually pick the stock that you want to do. When you're thinking about long-term strategies, you're putting most of your eggs in the fundamental box, in that fundamental analysis. That's what's driving this idea, if you will, of where the stock will be. Warren Buffett is thinking of Coca-Cola because he's looking at the fundamentals. He's thinking about how many people there were going to be, this is 30 years ago, in India and China, and the middle class would grow. These are fundamental thoughts. He's not looking at Coca-Cola in 1970 and saying, the MACD is crossing, the RSI is here, and, it's an uptrend. That's not what he's saying. So long-term thinkers reduce options analysis, reduce tactical analysis, reduce the time and energy they put into data analysis, and they're focusing a lot on the fundamentals.
Okay.
The short-term trader, active trader, is doing the opposite. There is fundamental analysis in the short term, but remember, thinking Coca-Cola, the value of Coca-Cola when it's trading 30 is 500. The stock's not going to 500 to reach your value in any short time period.
Yeah.
Same thing when you're looking at AMD right now. You might think AMD is valued at 110, but it might not get to 110 again for another year or 2 years or whatever. But you might think there's value at 70. It might go below 70, right? So that's the market. It's fluctuating around the value over time. And it's the market's perception. So again, it's this long-term versus short-term, which is very important to think about. Now, one other thing that's important for short-term active traders, stops. You're wrong on a position, you stop yourself out, you move on, you reassess, and you think about where you want to be in that position if you want to enter it again. Okay. Long-term investors also have stops. Most people think you just buy the dip, I'm going to hold it for 20 years. They don't think about stops. But long-term investors also have stops. Warren Buffett sells out of positions. You see him every quarter and say, oh, he just got out of this stock. What happened? He was stopped. But the stops are different with the long-term investors. than short-term investors. With the long-term investors, they're not thinking stock goes below 40, I'm out.
Right.
Stock goes, but that's not long-term. Long-term investors are thinking about fundamental stops. Management change. Your CEO of AMD, she leaves. Whoa, that's a big deal. A fundamental player might say, I did think this, but she was a big part of the story. And if she left, I'm not so confident in AMD anymore. You know what? I'm going to get out of the position right now. That's a fundamental stop, okay? As opposed to a price stop. Very different. So when I look at the wheel, I ask people, is it a long-term strategy or a short-term strategy? You're sort of a short-term trader up front.
Yeah,
and
point.
if you're wrong, you become this long-term investor. Okay, it's conflating the two, and that's the dangerous part. Not only does it confuse the concepts and what you should be doing, you're a long-term investor in AMD, and one of the risks of the wheel, which I'll explain in a second, is you can get trapped. So you're in this trade for a year because it went down first, and you get out and you just spent the whole year just to break even,
Right.
or maybe make a small amount of money. Is that short-term trading or is that long-term investing? It's a little confusing. So that's the first concept. The second concept is it a selling strategy or is it a buying strategy? The wheel is a selling strategy. So here's a selling strategy, and we're looking at selling versus buying strategies, option strategies. And the idea essentially is options are a probability game. You have to think of it as a probability game. There's percentages, probability chance of winning and losing, and there's payouts. And so in this case, I just take blocks of 10 to make it easy. And if you sell an option with a 70% probability of winning, which means there's a 30% chance that it'll be in the money. So 70% of the time you will take that premium, then you can map it out like this. You could say, 7 times out of 10, I'm going to make that $1. Okay. So I'm going to win $7, those $7. But what the market is saying, and this is important, what the market is saying is that the 3 times that you lose, you could expect to lose those $7. Now, it doesn't mean you do this 10 times over 10 days, 10 weeks, 10 months, that it's going to work out like that. But over time, that's what the market is saying. Okay. So the dollar that you receive inherits the risk and the probability that you could actually give back everything you've made over 7 months, 7 years in a flash. The risk reward, okay, the risk reward is balanced. It's equal. So a market price is going to equal this. Now, that's what the market's trying to say. So that's important. The issue is with these 3, there are unlimited possible losses. What happens if you're going to play this game and you just start playing and you get unlucky and you actually catch the 3 losses in a row? You can lose a lot of money very quickly. Okay, unlimited losses. So this is the selling game. Now, on the buying game, it's the opposite. You're going to buy a 30% probability of winning option. You're going to win only 3 times. And when you lose, you know that you're going to lose the dollar. Right. So the dollar you lose, that's in red here, you lose 7 times, $7. Yeah. But then on the green, the market is saying you will win $7 back, okay, over this 30% of the time. I'm using a block of 10. It could be a block of 100, block of 1,000. You're going to win that 7 to cancel out the 7 that you lost. There's unlimited possible gains, though, on this side. That is the leverage associated with these 2 strategies, okay? And that is important to understand. This, again, is balance and risk reward. To some extent, you know that already, but I want to make it clear for you. It is very, very important. So is it a valid strategy? Yes, it is a valid strategy, but there are nuances and there's things to understand before making a complete assessment. Okay. One thing I would say is people ask me, do institutions,
I was just going to ask you that.
Right. Yeah. Is it just a retail strategy or is it an institution strategy? I would say, believe it or not, that the institutions do a variation of the wheel. Okay. And you'll see it. You do see it out there, but they do it in a different way. And I'm going to explain their logic so you understand. Okay. Someone like BlackRock, who I think does this sort of variation. When BlackRock decides they want to get into a stock, how many shares are they buying? They're not buying 1,000 shares. They're buying not 10 million. Usually they're buying 25 to 50 million shares, right? I mean, that's how big these positions are. 10 million, depending on the stock price, but they're getting into these things in a big way. So if they're buying 25 million shares, there's a process, right? They're in the dark pools. They start buying it. They start accumulating, and they're trying to buy 250,000 shares a day. Have whatever's coming in. Where's AMD?
Yeah, 85 right now.
85-ish. Okay, so it gets down to 80. I want to get more aggressive. 75. I want to really start ramping up here. But they might say, well, you know what? I'm buying a little bit of stock here, but I want to sell some puts down at the 75 level or the 80 level just to get some more stock in, right? So they might sell, let's call it the 75 puts. They know, by the way, 25 million shares, it's going to take them 5 weeks, let's say, to get in, or 6 weeks. They're not going to do it all in one shot. It's going to take them time. They're going to start accumulating. The point I'm trying to say is that they will, with 25 million shares to buy, they might sell 10,000 puts or 20,000 puts. And you see that in the market sometimes. Usually you don't see 50,000 or 150,000, but you'll see 10,000, 12,000, 20,000. 20,000 puts is only 2 million shares. Okay, so you got to put it in perspective. For everyone in the world, 20,000 puts is like, whoa, 20,000 puts he sold. Wow. Like it, but put it in the grand scheme of things, it's 2 million shares of 25 million that he has to buy. So they're only doing it on, let's say, 10% of their position. Okay, 10%. On top of that, what do they know? They know that they are a buyer, a big buyer of stock as it goes down. So to some extent, they're selling a 6-week put, right? That's what they'll sell, a 6-week put. And they know what? They know that they're going to be buying stock, supporting the stock. And that put probably goes to zero anyway, because they're happy to buy it and they're pushing it up. So to some extent, they're doing it because they know they're a buyer, and it's almost like free money. And they're like, this is free money because if they got there, I'm buying a lot more. And 25 might become 45 if they really like it at 75, if it gets there too quick. So all of these things are part of them selling the puts. And once they get long 25 million shares, then what? The stock moves up, let's say over time, they're right. AMD goes back towards 85, 90, 95. When it gets towards 100, what do you see? You start seeing 10,000 calls for sale. And then they'll sell some calls. Maybe they'll sell 20,000. Okay. That doesn't mean they're getting out of stock. They're just taking in some premium. They might be getting stock, or they might pick the levels that they're going to start selling. They bought it at 75. It gets to 110 in 4 months. They're going to take some off likely. And that's how they might do it. And when I say lightly, they'll sell 5,000, 10,000 calls, which is only 1 million shares of 25 million. It's very small. Okay. So when people show, I see a lot of these guys, oh, look, they sold 10,000 puts. So look, they're selling 10,000 calls. For the world, it's a lot. For this particular bot, if it's BlackRock, it's really only 1 million, 2 million shares of 25 million. It's very, very small, which goes into the sizing of the wheel and something that I've looked at some of these videos out there and they don't talk about that. They don't talk about the sizing of the trade. They talk about targeted returns. And you might have a question about that. They talk about, well, we got to target, 10% per year, annual 30%. There's more risk involved. The higher rate of return you want, the more risk that's involved. So I think people would be surprised to hear that the wheel is done by institutions, but it's a variation of it. And they're doing it so people understand 5%, 10% of their whole position. It's nothing. It's nothing, it's nothing. And so when we talk about sizing, we'll put that into context. Those are important concepts you need to understand to appreciate the risks that are involved with the wheel. Now back to the wheel.
Yeah. So like back with AMD. So if I like the stock.
Yes.
The 85, instead of like.
Is this like, let's stop for one second. Is this a long-term for you? Or is this a short-term? It's like sort of like, I like it for the next year, 2 years. Okay.
Yeah.
Okay.
So,
that's fair.
Go ahead. I want a position in AMD. I'm thinking 100 shares. At 85. So in my mind, I'm thinking, well, I don't want to buy shares.
8,500 bucks.
Yeah, sure. I could buy 100 shares all one shot.
Okay.
Hold. But if I can sell premium at 85 strike,
okay,
sell maybe get $3-4 out of it.
Yeah, sounds pretty good. Sounds juicy.
Yeah, like I'm going to buy anyway. So if it's going to be
okay,
85, in 3 weeks,
why not do it?
Right.
Why not do it? Okay. I understand. That's generally the marketing pitch for the wheel. You're going to buy it anyway.
Right.
So just take a little bit in right now.
Yeah.
Well, we now understand long-term strategy. We understand selling versus buying. Now let's talk a little bit about the risk. I actually think YouTube does a tremendous job explaining selling on cash covered or margin. Like people now know you start doing things on margin, you're asking for trouble.
That's another thing with the margin. You only need to have like, I think 50% or something like that for
Yeah,
that.
yeah, of course, of course. With the
Not
margin,
really
with margin, you're leveraging now your portfolio. And if things go sideways, they go wrong, you can run into trouble quick. Remember, when you're doing margin, you're doing 50-50, right?
Right.
But who loses their 50 first? Not TD Ameritrade or you lose the 50 first, right? They take your money first, and then that's their cushion.
Right.
Your money is their cushion. Okay. But you do get the leverage. I think YouTube does a good job of explaining that risk, right? And you do hear a lot of people say never do the wheel on margin, do cash covered only. And then the whole you're going to want to own this anyway comes into play, right? Okay. So the problem comes with what happens when the stock goes down, right? What happens when AMD goes to 75, 70? Break 70 is a big level in AMD. I know 72, I think, is a big level long term. What if it breaks that? You're going to see supply in the stock just because people are going to get out, breaks that level. It probably goes from 72 to 60 in like 2 days. It could do that. You can't fool yourself that it could. Regardless if the fundamental value of AMD is 80, 90, the supply might overwhelm the demand and it could trade down. If it does trade down, an options guru says, it might be that the stock keeps going down, 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 down. 5 downs. Did I say it right? Down, 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 down. Of course, then you have to keep doing it. And your open P&L shows a larger loss, and you hope that it eventually goes up, right?
Yeah.
I mean, there's a lot to unpack in that statement. It's really bad. And that statement, of course, then you have to keep doing it. And your open P&L might show a larger loss, and you hope that it eventually goes up, right?
Wait, what do you mean keep doing it? Like keep doing?
Yeah, that's what I was looking to. So this is his quote, but he was talking about keep doing the wheel. Keep selling, either keep selling puts or sell calls or start wheeling, right? That's the moment where things start wheeling.
Yeah.
The problem is, depending on how far it goes down, depending on what strike you sold, you got to start asking yourself, well, then what am I going to do if the stock is down 30, 40% on a big drop?
You start rolling.
Yeah, and I start rolling. But what do? Do I sell more puts? When you think about, is it a long-term strategy or short? We'll go back to that big overarching concept. If you're a long-term investor, okay, people saying buy the dip, then you got to buy the dip, then you got to sell more puts, right? Even he says in some videos, down 30, 40%, I'm going to sell more puts.
Wow.
That's pretty damn risky. Yeah. That's pretty damn risky to just you're already losing in that position. You're selling more puts now. And people say, well, you're a long-term holder. You want a dollar cost average, which he has another comment. I'll show you this. This one's a beauty. Quote, so this is where you would lose $1,000 on the stock. Stock goes down. Right. P&L for the option, you still keep the $350 that you sold some puts. You don't have to give this back again. So this means now your loss would be reduced to $650. But 5 times, buts again, super important. You need to understand this. This is open P&L. Only if you would sell the stock right now, then you would realize the loss. This is actually manipulative. This is the biggest lie I have seen on YouTube. This whole notion of open P&L versus an open P&L versus a realized loss. I would never want to hear you say this. Never say, I have $50,000 in a stock and the stock is down 50% and I'm not losing on the position because I didn't sell it yet.
Oh my God.
Only when I sell it is it a realized loss. Yeah, realized and unrealized is just a tax term for the United States government. It's nothing else. It's the most ridiculous thing being said.
Yeah.
So this notion of realized loss and unrealized loss is silly, and should not be repeated. It's really a bad statement that's being said there. But the point is, what do? He's talking about continually selling dollar cost average. He even says, I mean, these quotes get ridiculous. It's really a shame to hear these things. And this is what people are believing. If the stock drops 30%, I do not simply buy more shares, but I keep selling puts at a lower level because the idea here is that I want to collect more premium. And if the stock keeps dropping, I'll get assigned more shares. He calls dollar cost averaging, DCA, the
Right.
magic. Wow. This is why people are getting blown up in this strategy, because they just think that it's just, okay, it's easy to keep going. I always go back to sizing the trade and then whether or not this is a long-term versus short-term. What happens is when people are wheeling, there's another risk. I call it the trap. What does that mean? What do we mean by that? Well, stock goes from 85, you wheel, goes to 95. Now what? You wheel again?
You can
What's
buy your
that?
putback. You can buy your putback.
Oh, yeah, but let's say it goes to zero. At the end of the month, it goes to zero. Now the stock is at 95. You made your $4. And 95, what do? You like AMD. You still like the
I mean, you
AMD.
kind of missed out on some.
Yeah, you missed out. But the question is, do you wheel again, right? Do you go, okay, I'll sell the 90 puts. Okay.
Yeah.
Stock goes up. Okay. You win there. You make money there. Stock
Okay.
goes to 105 the next month. You've now taken the two puts in your pocket. You're good. Stock's now at 105. Do you sell the 100 puts?
I mean,
maybe not. This is where
yeah.
people get confused. And
Right.
this is where you can get trapped. Because if it goes from 85 to 95 to 105, even 115, what happens when it goes from 115 back to 70?
Oh, man. Yeah.
Now you've taken the wheel. Now you're underwater. So when that happens, and I always explain this as, what about that example? People say, well, you don't follow the stock all the way up. That's silly. You don't keep selling the puts all the way up and say, okay, well, what are you supposed to do? Nothing. Like you found the stock that you like long-term for the next 3 years. You made $4, stock goes up and you don't do anything.
No, that's a good point. Yeah.
Okay. So that's the question I always have. And people, well, you just find another stock. You keep wheeling.
Right.
Yeah, but it's hard to find other stocks that are just going to go up, right? Because that's the other. We'll get to that part in a second. Okay. But it's hard to find stocks that are just going to go up in the long term. Okay. That's what everybody's trying to find and everybody's trying to look for. Or if it keeps going up and you keep selling puts, you realize that you can get trapped. And a lot of people get trapped. Right. That's what people are trying. Not only is it increasing the risk, right? Because an $85 put has a notional value of 8,500.
Yeah.
Yeah. At 95, if you sell that put, it's $9,500. At 105, it's 10,500. Okay. So the notional value of that put you're selling goes up as the stock is rising. And that's where you can get trapped, because if it goes lower, all of a sudden you own a stock. If you're on margin, and it has a big drop, you're going to start eating on the margin and you can get called on your other portfolio. Okay. Right. So that's the problem. But if it's cash protected, you're still down there. Now you have an average, you basically bought the stock at, let's say you did at 105, you're long at 105, you've taken in, let's call it $10 on these puts. So you're long at, 105 less 10, about 95, the stock is 70, you're down $25. Now what do? You got to sell calls at 95, but those 95 calls are nothing. It's small premiums at 95. So now you just own the stock at 70. Right. Now you're just waiting. And now you really are a long-term holder. And then I say, well, do you really know the stock? Like, where's your stop on the stock? Well, I don't have a stock. I'm a long-term holder. Well, goes back to what we were saying. There is a stop, even for Warren Buffett. Right. There's a fundamental stop, and people don't know when that stop is. What a lot of times you'll hear is, well, if it goes down 30%, I'm just out. So that means it's really not a long-term play. It's really a short-term. So, most people tell me that it's a long-term strategy. They want to hold it, but then they say if it drops $30, I'm out.
Yeah.
You're conflating the risk of the two strategies and the psychology and the methodology. That is a problem, and that's why it's confusing. So this is the confusing message that's being sent out. It sounds easy, do this, do that, and keep going. But that's another risk, is getting trapped. So the risk of cash secured versus margin, and the other risk is this: what if the stock goes down? What do you do? Stock goes up. What do you do? It goes against whether it's a long-term versus short-term strategy, and also sizing comes into play. It's a big deal. Sizing comes into play. Okay, now getting trapped we talked about, and then we could talk about this sizing a little bit more, because people say, yeah, but I want to be long the stock, and so what? Like you were saying, but if you think about portfolio theory, and they say you should have, some people think you should have 50 stocks. Some people say 25. Some of the big hedge funds say 5 stocks is good. There's all different theories, and that's fine. But generally, 5 stocks is probably the lowest to get some sort of diversified portfolio. So the question is, how big is your overall portfolio? Then divide that by the number of stocks. So you have 100 grand.
Okay.
Divide that by each stock 5. So it's 20,000 each stock.
Yep.
Then I'm telling you how the institutions do it. They do only 10%. So 10 to 20%, let's call it, give you 20%. 10, 20% of 20,000 is $2,000 to $4,000. So if you have $100,000 portfolio, then the notional value of your wheel should only really be around $2,000 to $4,000. Remember the notional. So it's a $40 stock, a one lot, a one contract is of $40 is $4,000. That's appropriate sizing. If you have more than 5 stocks as a diversification, then you could see that go lower. For most people, it's going to be extremely risky for most people.
Yeah.
Because they don't have, most people that are putting money into this don't have 50 to 100 grand.
So if you have a $10,000 account,
no chance a $10,000 account should be. I mean, just think about it. 10,000 divided by 5 stocks is 2,000. You don't have enough money to actually one contract is for $50 stock is 5,000. And you should be, and that should only be 20%. You got to multiply that by 4 or 5, should get you to 25,000. You don't even have that for one contract. So think of that's why I'm saying it's very, very risky.
Yeah.
But if you have 100,000 portfolio and you want to wheel the SPY, that's different because the SPY is what? It's 500 stocks.
Right.
I would also not do the whole 100,000. I would do less and own some of the SPY in case the SPY just goes up. If you wanted to do it like the institutions, then you got to have a bigger portfolio.
Yeah.
Okay. You got to start with a bigger portfolio. But the other part is you won't find these institutions just sell puts. They are buying stocks because they think it's going up.
Right.
Okay. And because they think it's going up, they want to be long the stock. They sell these puts for $3 on a $60 to $70 stock, $80 stock, and the stock rips 20. And they're not happy that they made 3. And then sizing of the trade where you have to do it at a much lower scale. And what you'll find is when you're doing the wheel at a lower scale like that, as a percentage of total profits, you're never going to get 25, 30% annualized.
Annualized, yeah.
You're doing it at a tenth of the portfolio, right? Mm-hmm. This is, again, part of the problem. Now, the main issue that no one talks about, gap risk. Gap risk is you wake up and what's her name? Lisa's CEO, Lisa something. She resigns. How much is the stock down on her resignation? Like out of nowhere, just go, you know what? I'm out. Thanks.
Oh, man. Yeah.
Stock will get crushed. So gap risk is when a stock goes from 85 to 50 overnight because of some news. Let's say something like that happens. Or AMD has, accounting issues and the SEC is looking into them. Whoa, out of nowhere. People think that can't happen. It happens, even to a Warren Buffett stock. Okay. Right. He was in Kraft and that happened. So these things happen. It can happen to any stock. Okay. And you're saying, well, I was going to buy it anyway. Well, you just bought it at 85, right? Less than $4 at 81. You bought it there. And it's saying, well, it's the same thing as having like a limit order. Well, in limit orders, you could actually buy it lower. If you had a limit order to buy at 80, 81, okay, because that's where you're buying it with the puts, that may never get triggered because this news might come out at 7 a.m. and the opening price is going to be, call it 50, 51. So you might buy that there. What you are giving up with selling puts is this gap risk. Okay. And people don't talk about it because it's why most institutions are not selling options. They don't like giving up that gap risk. That's why most institutions are not putting limit orders. They generally are not doing that because the gap risk. They want to be in control. If it goes down a lot, they want to be able to say, whoa, I don't really want to buy it at 81. This news just came out. I'll pay 50 a little bit here. And if it goes to 45, everything changes. Right. When you sell options, you don't have that right to sort of figure things out and say, do I want to be in it now or not? You give that up. It's a real risk. It's not going to happen every day, but that is the risk. And when that happens, your portfolio in that particular stock will blow up. And again, it does happen. Flash crash, intraday, boom, boom, boom. All of a sudden it's, lights out. Nobody thought a flash crash could happen until it actually did happen. What's the next situation? Nobody knows. What if we wake up and, people like, wheel on Apple or something that's, very secure. Well, what if Taiwan gets taken over? And I don't know if it's going to happen. Nobody really knows when it's going to happen, if it's going to happen, why it would happen. It's something that is an unknown. When you sell options, you are selling that unknown. And that is a risk. And people say, well, you were going to buy it anyway.
Right.
Yeah, in a normal market, you want to buy it. But like I said, if we wake up and AMD has accounting irregularities, would you want to buy it?
Yeah.
Maybe not. Maybe not
Yeah.
at that moment. You want to watch, you want to see what's happening. So this is clearly a risk that no one talks about. In a nutshell, it's why IVs are a little bit higher than historical. It's why people say options are expensive and that's why you should always sell them.
Yeah.
Well, that statement is completely wrong. Okay. IVs are usually a little bit higher. It's called a risk premium.
Okay.
That risk premium is what the buyer is getting in the event of some crazy event. Always remember that.
Wow.
That makes
Okay.
sense?
Yeah, it does. Okay. Yeah.
So it's a lot being thrown at you here. Okay.
Yeah,
But we got it on record. You're going to have this and you can review it. But we're laying everything out. But here comes the big issue. Learning can be exciting, and there's no better place to learn options than at optionsgeek.com, where you'll find groundbreaking education, game-changing tools, and great options trade ideas. Now back to the wheel. The big issue is stock selection. People are constantly saying, don't do it on this stock, don't do the wheel on these stocks and that stocks. The reality is, like I told you, the market price takes into account supply and demand. Another way of saying that is that the risk reward is balanced. The risk reward is balanced. When you look at a stock price, that's everyone's expectations built in right there. When you look at option prices, the option price is the market's expectation, supply and demand. Okay. Tesla, an option that's 10% lower is going to be priced at X. And someone's going to say, well, you never wheel on Tesla. And my response would be, why are you saying that? Why do you say you never wheel on Tesla? Is it too risky? It's not necessarily too risky. I mean, the market is pricing it according to a balanced risk reward. And if you look at Tesla down 10%, the price is X percent. And if you look at, say, Coca-Cola down 10%, the price would be much lower. Why? Because that is the market mechanism saying, we know Tesla's riskier than Coca-Cola, and that's why these premiums are higher than this. And so the market is balancing it for us. So saying that you should never wheel Tesla is not necessarily true. Okay, because the market is pricing the risk reward on Tesla. You're gonna get paid more on every put you sell in Tesla, but if it goes down, the market is saying you could lose a lot as well. Right. That's all it's saying. What people I think are trying to say is that the P&L swings of one versus the other might be higher, and that might cause problems in your portfolio. That is true. But as far as never doing it on Tesla, that blanket statement I can't agree with. Okay, it's up to the person and how you size the trade, goes back to the sizing part of that trade. What I find interesting about this stock selection, maybe the best quote, only do the wheel on the ones that will go up longer term.
Yeah.
Period. Yeah. As if it was so easy to do that. Right. As if, listen, the wheel works. Just only do it on the stocks that go up.
Yeah. Okay.
Now, how do we do that? It gets even better. This is the most ridiculous thing I've ever started. He goes to show how he would do that, or the ones that he wheels on. Go to Google Finance. Once you click the symbol, you'll see this chart, and it has revenues and profits. And revenues, you see, they go up, 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 up. And I think it was 5 ups too. And you see profits go up, 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 up. Both not so fast, because if it goes fast, that's the sign of growth. And if it goes just up, up, up steadily, that's value. Okay. There's your fundamental analysis. That's how you pick a stock. That's how I'm picking these 20 names. So I just picked a stock that I'm going to wheel on because I think it's going to go up long-term in about 45 seconds. That was okay. Yeah. Is that even logical to think that way? Is that that's silly?
Wheeling. I mean, when I think of wheeling like good stocks, I think generally people think of Apple, Microsoft, the big names.
And you know what? I can kind of go with that to some extent, right? The problem that I see is that prior to 2021, when growth stocks just completely collapsed, if you look at all the wheel videos prior to that date, they're all on the growth stocks. They're all on Square and Uber and Tesla and every one of the growth stocks because, hey, you know what? It's like nobody cares. We're doing it and it goes up, 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 up. And, we're all winning.
Yeah, that's a good point.
After 21, all of a sudden they had to come out with these videos and say, oh, yeah, by the way, You don't want to do it on growth stocks. You want to do it on value stocks. Well, value stocks are not going to, remember, prior to 2021, he was saying annualized returns of 30%. That's what you're looking for. Annualized returns of 30%. Well, you're not going to get that with value stocks because value stocks have lower volatilities, lower premiums, and you're not going to get even close to 30%. But if there's something to be said, if you want to do it on Apple, on the solid names, the top 25 names, sometimes the FANG names, they've worked in a great way over the course of the last 10 years, but they also could have their big drawdowns. And like I said, you run this risk of the whole market collapsing, they come in. So the question is, well, Felix, and what strategy can you use? Because you still have to pick a stock, right? In some way. And I think it's valid. It's just, stock selection in the wheel is most important. It's a long-term strategy in my mind, especially when you are willing to buy it lower, down 20, 30% and buy more.
Yeah.
You're talking about a strategy that you believe is a long-term strategy, which means what? We go back to the beginning. Fundamental analysis is key, not technicals, not I like the stock here because the RSI is, kind of turning up, fundamentals become key. Okay. And how many people are doing the work on the fundamentals here? How many are these retail? Who's doing it? I just showed you the answer that they give on choosing. It takes 30 seconds to pick, 45 seconds. That's not fundamental analysis. I'll give you an example. Okay. And it's documented. You can read about it. Bill Ackman. Years ago, Ackman took this big short on Herbalife, and he was all over the news. He was shorting it. He had done a lot of research. He was interviewed talking about like predatory marketing by the company, on and on. He was $1 billion short, and he spent $50 million, $50 million in research, sort of putting the word out there. $50 million. It's a lot of money. And he was wrong. He actually didn't make any money. Carl Icahn took the other side and wound up making all the money. I say that to show the point that these hedge fund managers are spending enormous amount of time, resources, manpower, and money to develop these ideas, all their ideas. That's what they do. What is the average investor doing? How is the average investor going to compete in finding these stocks that just go up, up, up? It's very, very difficult is the point. And it is a risk when you're just randomly selecting stocks that you like. That would be generally a short-term trading strategy as opposed to long-term. And again, the confusion starts. Am I a long-term? If it goes down $30, do I still like it? I don't even know. And, I got to learn about it more. It's very, very difficult. It's not easy. And this whole notion that you could just pick stocks that go up is not appropriate for someone to say that. People will then say, is it right for me? What should I do? I'd rather see you do the buy right. Almost the same thing. You're getting long the stock. You could sell some upside calls, and at least you're getting the upside because in reality, that's why you're getting long the stock. You want the upside. And if you miss it on the first month and it just starts going, you do all this work and all this sort of thinking about which one you want, get into stock. You want to sell some calls a little higher, 5, 10%, get into stock. But to sell a put, to make $1, $2, and then have it go up, and then you can't really sell any more puts because you can get into this trap. It goes against sort of the whole concept of I want to be long the stock. And then when you sell calls against it, I wouldn't sell calls against the whole thing. At the end of the day, it can go way up. You think AMD's in 2-3 years is probably going to be, some people think it's going to be, in high 180, 90, 200 range. Who knows where it's going to be? But at the end of the day, if you sell calls and you literally pick the right stock and it goes that far, you're going to be trying to roll up those calls each time to collect. It'll win, but it's going to win 15% of a 60% move.
I think the big takeaway is the gap risk, really. The anxiety associated with that, just, waking up every morning and it's like, well, let me check.
That is a big one. And that's associated with size as well, the sizings. Like if you sized it correctly, it's not going to hurt as much. If you're one position is 20 grand and you're doing puts on 4 grand and it gets chopped up by 50%, it's going to be a very small percentage of an overall portfolio. But this is how you think about it. Long-term players, they can sell options, but you got to really be long-term and you got to do it on a lesser scale because you can get caught. And when you get caught, it doesn't hurt. The biggest part of the wheel is stock selection, size in the trade,
Strike.
and how you pick that strike. Those three, I would say, are the ones to really focus on. Stock selection is fundamental analysis, and people get their MBA to sort of
Yeah.
understand how to value a company.
With strike selection, I think, I mean, what I've been reading online is like,
strike selection is important to the wheel. Sure, there are a few easy answers that people talk about, and then there is a better answer, but I'll leave that for another time.